I'll tell you, I do realize, it's an intuition thing and it's not how we should make investment decisions. But one of the things I do think is a real signal now is like when my phone rings, how do I react when I see a name? And when I'm chasing a deal and I like see that founder text or call, am I like excited? Do I want to talk to them? Am I like looking forward to the conversation or am I like, ooh? And if you're ever feeling that way, like, what is that going to mean when you're 5 years into this investment relationship and you're in a hard period, right? So I do think about that. I don't think it's the barometer for investing by any means, but a little bit of a trust your gut moment.
Hey everyone, this is Prashant and I'll be your host for the VC 10X podcast. And today we have Liz Christo with us. Liz is a partner at Stage 2 Capital where they are investing in early stage B2B startups. In this episode, we talk about Liz's story and how she started investing. How should B2B founders think about go-to-market strategy? This also shares insights into Calendly's GTM strategy, importance of data in GTM, how to assess for co-founder compatibility, and so much more. So without wasting any time, let's dive straight in. Hey Liz, so good to have you on the VC10X podcast. How are you doing?
I'm doing great. Thanks for having me on.
Yeah, pleasure having you here with us today. And to start things off, can we first have your story and how you started investing?
Yeah, for sure. So I am an operator turned investor. I started my career working for a very small startup. It got acquired into a public company, NetSuite. And this was way back when, pre Oracle acquisition. And I worked in a bunch of different parts of Gotomarket there, all selling ERP to CFOs. So I started working in sales operations. Then I moved into account management, selling software into the install base, worked on many of our acquired products. And then moved to the top of the funnel and was building out the BDR team globally. So I had a pretty large team doing lead gen and inside sales. And then after about 8+ years at NetSuite, I kind of had that itch to get back to earlier stage. I kind of woke up one day and realized this is a 5,000 person company, not the 50-person startup I had joined, and tried to figure out what came next. And so for me, that was my first foray into venture. And I ended up joining OpenView Venture Partners. And incredible team, incredible platform. I went in to run the post investment group, which was really building out a team of consultants to work with portfolio companies post investment. Everything from recruiting to pricing and packaging strategy to go to market work to marketing, demand gen. You pick your flavor, mostly related to go to market. But if we could help the portfolio companies do it, we wanted to do it with our team. From there, I ended up joining the partnership at OpenView, became a GP, and joined the investment committee. And when I did that, that was sort of my first, I would say, like real exposure to investing, where I was a decision maker on deals we were doing and actually like working on our funds. Over time, I took over more responsibility for the investment team. It just sort of was this natural transition. And ultimately, decided to make a change and join Stage 2 Capital in 2021. And for me, that step was really about, I guess, was a few things. One, being a little bit earlier in the life cycle of investing, both the types of companies and the stage of companies we're investing in, but also the stage of the firm. And so OpenView was this incredible platform. I had awesome partners, but as I thought about like putting my stamp on something, joining a fund at fund two instead of fund six looked a little bit different for like the impact I could have. And then the final thing I think that really drew me to stage two was just this focus on go to market and how well it aligned to my personal experience and what I think is important in investing, which we can certainly dig into more, but hopefully that gives you like the story arc of how I got to where I am today.
Absolutely, it does. And that's an exciting story, starting from being an operator, then joining the platform side of venture, and now finally in the investing role
Yeah,
at Stage 2, investing directly in startups and not just investing, but also helping them in the go to market
right.
strategies, which is something you focus on. Can you talk about how do you think about go to market strategy? Because you've worked in a role for around 8 years and then switched over to platform again, helping founders,
Hmm.
in various aspects, and now finally investing plus helping, right?
Yeah,
How should founders think about go to market strategy, in your
yeah.
opinion?
So, I mean, it's funny. I think there's a lot of ways to answer this question. I would say, let me like start by how like I think about it as I'm assessing a company. I think I start with thinking about
Sure.
who's the ICP. And generally speaking, I think companies define way too broad of an ICP and have this like inclusive view of we can sell to anyone and look at all the different ways that we could be used and the different use cases and value props. And I think as I think about designing a really strong go to market, you got to get like way more focused. And so the tighter you can make your ICP and the more resources you can actually put towards one segment of your customer base or to your potential customer base, the more effective you're going to be. And so it doesn't mean you can't have additional use cases or you can't explore a broader ICP or TAM over time, but start with something really focused. And the rationale for that is the more similar those customers look, the more similar those buyer personas look, you can actually map a buyer journey. And so you can understand, what is that buyer feeling? What is the pain? What is the challenge? What is the opportunity they see? And how are they going to go about that buying process? And what are the steps along the way? And when you can put yourself in their shoes, you can start to build a sales process that matches. So, we have had so many iterations of go to market in the last, I don't know, what, 40 years where software has really been around. As we think about, sort of the original like field sales motion, we're selling like heavy infrastructure with the rise of cloud, a more inside sales motion, the rise of content marketing. And now I think product led growth has really like taken the world by storm. But even that's like iterating really quickly. So it's not for everybody. As you think about your buyer, there are particular kinds of software and there are buyers and then sales motions that need to match them that are still going to be enterprise, that are really heavy on a pilot and a POC and have large ACVs and are huge investments. And at the other end of the spectrum, you have somebody can swipe a credit card for $3 a month and they are a customer. And so there is not like one size fits all answer here. It starts with, who are you selling to? And are you matching your sales process to what they are going through? And I think too often we define a sales process that looks good to us or that makes us feel good, like we are following up every X number of days and we are checking in on things. And rarely does that actually add value to the buyer on the other side. So I'll start with that. And I realize that this is like that kind of like broad, lofty view, and I'm happy to dig in like anywhere along the way. But I do think that fundamental beginning of just who are you selling to and what is the value you are providing can actually drive what is the sales process you should be designing. That makes sense?
Absolutely. Yeah, it totally does. And talking about sales process, so how do you prefer, should founders think about the sales process and designing it in the first place? What should be
Yeah.
the first way they are reaching out to their potential customers? And then if they think they are a fit, then what should be the ideal way of following up? If not following up, then what is that, right?
Yeah. I think this starts with like the founder led sales process. And, a lot of what I guess I've spent my time on in the last almost decade now is helping founders make the transition from founder led sales to the first professional sales team to actually scaling that sales team. But it all starts with a founder motion. Like, you need to sell your first X customers. And I put that X there because in an enterprise sale, it might be that you get to 1 million in ARR with a handful of customers. In a product led or self serve motion, you might need thousands of customers to get there. So I don't think there's one right answer of like, this is where you need to get on your own, but you need to start to build something that looks repeatable. It can't be, hey, I sold to my 10 closest friends or referrals, and like, I expect you to do the same for a sales rep. So I think it's starting with like, learn the motion yourself as you understand your buyer and you get really savvy on understanding that market and the motion they're going through and you're matching to it, then you can start to think about how to make something repeatable out of it. But I think it starts with doing it yourself. So I don't mean to minimize the network sale, to be clear. I think that actually is very much how most founders will begin selling a product. Likely you are founding a company in an area where you have expertise in a network and you have like felt that problem, and that makes total sense. So you're going to start with people you're going to have conversations and you're going to explore, and that's going to lead to your first early customers, and that's great. You should do that. But then it's starting to think about, okay, who looks like them, right? Who are the next 100 targets that look like this group of people that's deriving value from the product today? And then how do I go get them? And that I think is where we get to like some of the top of funnel and demand gen strategies. And back to the focus angle, one of the things we spend a lot of time with our portfolio companies is like, don't do too much. Like, ideally, we want to find one or two channels that are actually working and really lean into them. And there's a lot of experiments to find those, but I don't think you can take a really small team and one junior marketer and say, okay, we're going to turn on all of these channels at once. We're going to have paid running. We're going to build a content program. We're going to have an event strategy. We're going to distribute content through, like, it's too much. And so figuring out like what are the one or two things you're really going to lean into that can have the most impact. And those aren't the same at every company and they aren't the same for every buyer. So it really is like inspecting your own unique company and situation and trying to decide where you want to lean in.
Yeah, I totally agree. And several important points you mentioned there. And one of them being founder led sales, that initially
Yeah,
the founder has to lead the sales process from the forefront, right? You cannot just hire someone from outside and ask them, okay, you like figure out sales for you, I'll take care of the product, you know?
yeah.
Yeah. So that's a really important takeaway here. And another one that I would like more clarity on is at what stage you say there's no particular stage wherein you can say that you can actually transition from yourself being the like forefront salesperson for the product to like hiring a team or hiring at least the first sales representative and then
Yeah.
starting to make that transition. At what stage do you recommend that happens?
Um, I This gets so tricky because it depends on so many factors, but I think I would start by thinking about what is the go-to-market motion here? Is this product led? Is it sales led? Is it enterprise? And then also you need to think about like the funding structure and the unit economics behind the business. So there may be a world in which you are a technical founder and you are selling a relatively self-serve product to developers, and when you hire your first AE or CSM or whatever you want to call the person that's sort of helping people move through that self-serve onboarding, could be really different than someone who's selling, enterprise software to government. Um, so I guess I share that with this caveat of like, I don't think there is a right answer. I think it comes down to, do you have some customers that are consistently deriving value? Can you actually onboard somebody else and show them how to do what you are doing that is working? Or can somebody help accelerate that with you? And then you're just making the trade-off of like how that impacts burn and your ability to grow. And there's a lot of different sales efficiency metrics we can think about here, but in the early days, like, they don't need to be perfect. You need to make some bold bets to figure out what you can actually scale. And so it's probably going to happen somewhere between, that pre-seed and A round, but they look really different at different companies. I think the critical thing in that first sales hire is you're really looking for somebody who's more of a generalist. You're not trying to go out and say, I want the enterprise seller who has worked at Oracle for 20 years. Like, you need someone who's scrappy, who has like done cross-functional work, who can collaborate with marketing, do some of the customer success activities, will learn the product, will give feedback. Like, they need to be a bit of a jack of all trades, but really motivated to actually like help you figure it out. This isn't like they're walking into a playbook that they can just execute. They got to get excited about the journey of figuring it out.
Yeah, absolutely. Totally agree with that. And I think the go to market strategy would look different for different companies. So, can you talk about how the different kind of companies take different approaches for go to market?
Yeah, maybe we talk in like real terms about some companies, because I think that, I don't want to keep saying the same thing of like, if you're product led, if you're enterprise, but um, let's look at a company like Calendly. So that was a deal that I worked on when I was at OpenView. And in the early days of the business, it was completely self serve. They've since layered in a sales motion, and we can talk about that too. But the early days was like a huge amount of experimentation. And there were a couple of levers we were trying to pull. So, one is like, how do you fill top of funnel and get website traffic to your site to actually sign up? Two is, how do you get people into this free product and actually get them activated? And activated was all about actually booking a meeting. And then booking a meeting inherently exposed someone else to the product, which was really cool. So it had this like very interesting like network effect where every time a meeting got booked, someone was exposed at the other end. And so from that, what we were trying to figure out are like, in these levers, what matters? Are we trying to increase the number of people that go from website to sign up, from sign up to activation, from activation to like the nodes of how many people they're sharing it to? And there's obviously so many things we could influence there. And we haven't even gotten to the part where you then go like, where do you hit a paywall? And then separately, like, how do you then expand to like a team or enterprise rollout from that one initial credit card swipe? And so I share that example because the person we needed in the early days there was not this killer enterprise seller who was going to go call on the CFO and negotiate an MSA. We needed someone who was really data oriented, who wanted to get very analytical and think about the different growth levers we could pull and design a set of experiments and rapidly iterate through them. So that early go-to-market team was more of like a growth function. And then the second and critical part of that was what we called at the time customer success, but it was really this like, I think it's what we would really call more of like a sales assist now. And the concept was like, when people are engaged in our free product, what are the signals we're looking for that tell us that they're either a likely buyer or that they're having trouble? And let's make sure we're inserting a person at the right time to help them get over that hump, whatever it is. And so that early go to market team, I think, was like very different than like at the other end of the spectrum, enterprise companies I've worked with. I'm working with a company right now where we're selling to like a government entity. And that sales process is full of RFPs and bid and tender processes. It's long, it's daunting. It is very different. We want somebody who can navigate that, who can run a 9, 12, 14-month sales cycle and manage all of the stakeholders involved. It's just a very different persona. So I share those two examples as sort of like the two polar ends of the spectrum, and then realizing that there's a lot in between. And I think that also brings up like one other thing that is a thing I'm spending a lot of time with portfolio companies thinking about right now, which is like, how do you segment the roles in a go-to-market team? So SDR versus AE versus these post-sale functions of implementation and customer success and account management and renewal and upsell. And there are all these specialized functions. And at the very early stages of a business, like you can't afford to have one person doing each of those tasks. So they get grouped together. And again, I don't think there's like a right or wrong answer here, but it is understanding how you can like best utilize the people you have to make sure that you're delivering a great customer experience. Um, so that might be that like the person who sells the deal actually needs to see it through that initial implementation. And they're checking in and making sure that the customer gets activated and they don't get paid, sorry, until the customer is activated. Or you make a decision that aligns them to that like plan of the business. So those are, I guess, some of the examples that like come to mind for me. I don't know if there's like an area like you're that I didn't touch on there that you think I need to go deeper on, but hopefully that gives you a little bit of an idea.
No, that's great. That's great. I think that's a great approach to answering that question, and people get a deeper insight into that by listening to an example there. And like another thing I wanted to talk about is when you're thinking about go to market, like there is always a funnel, right, to the sales process, right?
Sure.
So, so how does that funnel differ across different companies, and at what like there's a top of the funnel, there's a middle of the funnel, there is like the
Hmm.
bottom of the funnel, right? For some people, the top of the funnel, you're like right away off the bat, you start asking for a payment, right? You ask them to pay to use the product. But then a product like Canonly, like it thrives on a freemium model
Hmm.
upfront, but then later on you can upgrade to have a paid subscription as well with additional features, right? So how does that funnel look like for different companies, and how should different kind of companies design these funnels, especially talking in terms of B2B startups?
Yeah. I mean, I should share. So like I focus on B2B software. So like almost every example I'm going to give is related to like enterprise B2B software. With that in mind, I think there's a couple of things you layered in here. There's like how to design a funnel. There's like where you put a paywall. There's how you think about pricing. On the funnel front, look, there are like standard ways to track and measure some of these things. Marketing, accepted lead, and MAL, and MQL, and SAL, and SUL, and opportunity. I don't care what we call them. What I ask founders to do and sales leaders to do is think about what are the actionable steps that you can measure and automate in your funnel today, where we can look back, ideally 6 months, even three, just to see what our baseline is. How many like people, right? How many individuals came in at the topmost of your funnel, right? And then of those, how many reached whatever your next stage is? And some people may not be able to like delineate into 9 steps, but everybody can tell you how many website visitors, how many people submitted a form or signed up for a product, how many people was there a real opportunity, and how many of those did we win? So there's going to be 4 steps no matter what. And what I like to start by doing is just tell me the reality of where we are, right? Look at the last 6 months and count it up. And if you can do that, then we can start thinking about where can we improve or what are the areas that we're trying to focus on. And then we can also do like a better design of the funnel of what should we be tracking over time. So for example, like if you're going from like you've got website leads and you've got opportunities, like there's a lot in between that we could impact, and we need to break down what we're measuring. But it comes back to that buyer journey, and like what are the steps the buyer is going through so we can actually match to that. But yeah, I would start with the data, and then I use that with our teams to build a bottoms up plan. And what I mean by that is, I think too often I see, particularly in the fundraising process, a top down plan saying, we did 500K in revenue last year, and we're going to hit 3 million in ARR this year. And you look at that and you're like, how? Like, what are the assumptions you made to get there? And usually they're like, it's not that it's not thoughtful, but they're kind of guesswork. And it's like, well, if this happened, we could do Y. So we want to marry it up and say, okay, well, for the past 6 months, you've been generating 200 leads a month, and that's been closing 2 customers. So we can follow that all the way through. And, maybe that's 8 opportunities and that's 20 demos. And you kind of go through this count back process and you go, all right, well, to change the scale of the business that much, something really needs to give. And so you start by modeling out, if you just kept doing what you're doing, where would you get? And then you want to actually think about, how do you layer in some strategic bets in the business? And how many people and capacity does that take to do? And so I share that example because I think if you can start with the data of your funnel, you can use that as the leading indicators of what your outcomes are going to be in the future and how to hire against it. Um, that I think is like a fairly standard sales led approach. But if you're looking at like a product led or self serve business, it's actually pretty similar. You're just going to layer in people differently, but you still need to measure the same things. The steps just look a little different. So it might be how many visitors, how many free signups, how many activated, how many paid, how many renewed, and looking at like expansion within those. Or in the Calendly example, like what is the referral rate? So for every one person I get on the product, how many more get exposure? Narrowing in on what those like critical metrics are make this whole exercise so much easier. But I would just ground it all in like the reality of today. And if you can't measure what you're doing today, just like stop spending money. It's so funny. I'm working on this with a company right now, somebody we've been spending time with, where you're like asking a lot of these questions and they don't have the mechanics in place to actually say what is performing. And so if you're spending money on paid channels, but you don't know what rate they're converting at, it's just like throwing money out the window. You don't know how to double down or like where to spend more.
Absolutely, totally agree. And you mentioned about the Calendly referral system and how every user actually exposes it to more users,
Yeah.
and it creates kind of a viral loop, right? So let's talk about product-led growth there. What are the other kind of implications you've seen of product-led growth, where the product has it embedded in itself that it's going to expose itself to more users as more users are added, like
Yeah.
it has a compounding effect on how many more users or potential users are getting exposed to it.
I think that's one piece of product led growth. Like there are a set of companies where that's the norm. Calendly is a good example.
Yep.
Slack is a good example. You don't like sign up for a chat product unless you have somebody you're going to chat with, right? There are other PLG products that don't
Yep.
have that same that same sort of like exposure network, but can still be product led. And so I think one of the
Yep.
movements we're seeing right now is buyers generally want to see and understand the product more upfront. And so we've seen like sort of a rise in this category of software products that allow you to show your product on your website. So a company like a Salio or a Walnut or a Demo Stack that's actually allowing you to like put an interactive version of your product out into the world. Let somebody like get exposed, see it, and understand what they're buying into, or even what they're signing up for. And then once they like actually can get exposure to it, they're more likely to start a trial or to engage with your sales team. So I'm definitely seeing that trend. And then I think on the product led front, look, some of the things to think through are the math on these businesses. When you think about the funnel, like the conversion rates are so low at every step. And so thinking about, do you have the right data and tracking to be able to optimize that funnel? If you need 1,000 people at the top of the funnel to get one paying customer, or you need 5,000 to get one paying customer, you better make sure you're doing everything you can to capture those people along the way. Um, I don't know that I don't know that's necessarily materially different in a product-led business than another one, but I think generally what you see with product-led businesses is the potential buyer set is much larger, and because of that, there is more volume at the top of the funnel that you can go capture versus an enterprise product where you have a much more finite, like, I know that my buyer is the VP of operations at companies with more than 2,000 people in these three verticals. And so it becomes sort of like condensed where you have a much tighter targeting strategy than the broad mass of like put your product out into the world. Does that help get to what you're thinking of?
Yeah, yeah, absolutely, it does, and I totally agree to that. And are there any mistakes that you see founders often make? Right, you are kind of an expert in this. You know what to do where, but then
Yeah.
what are the usual things that founders tend to do that are usual traps or mistakes that they fall for? Yeah.
I'd say the number one challenge I see is hiring too fast. Um, Particularly on the go-to-market side. And I think that there is a little bit of a legacy and some bad behavior around this from the last many years. You look at the amount of funding and the like pressure on top line growth. And I think there is this natural state where you say, okay, well, we've got a CEO, we've got an AE, and we need to hit this number. So we're going to go hire six more AEs, and magically we are going to hit that 3 million target or whatever the goal is. And the challenge we see is that hiring people doesn't create demand. So you need to make sure that you're actually scaling in a way that those sales reps you're hiring or those SDRs you're hiring actually have a shot at hitting their number. So what does that mean? It means tracking the funnel we just described and knowing that if we need, 100 leads in order to close whatever number of customers at the end, we better back in and make sure that we can produce that many leads. Because hiring a bunch of expensive salespeople and not having enough demand is just a recipe for disaster. So that's like my number one mistake I see is just hiring based on excitement rather than data. And so we are always encouraging people to kind of slow down on hiring, to show that you have successfully ramped and understand what it looks like to bring some new people on board, and then pace out that, like meter out the hiring over time rather than doing that big, like swift, bring a bunch of people on. Yeah, that's probably the biggest one
Yeah.
I see. How about you? I mean, you've had a lot of these conversations. Are there other things that stand out to you?
Yeah, absolutely. So I tend to mostly talk about investing and how
Hmm.
the mistakes that founders typically make,
Yeah.
and I think that that one has come up quite often. Why? And the reason being that since this is a venture capital podcast, we're talking to VCs, and so when the founder gets funding, their next thought is that okay, I got funding. Next, I'm going to do hire these many
Spend
people
it.
and yeah, spend it right, and I'm going to get the results that I promised in my pitch deck,
Hmm.
right?
Yeah.
So that, like you said, doesn't happen. You need to have the correct processes in
Yeah.
place. You have to have it figured out, and then you can add more people to it. Then it kind of works. But if you don't have it figured out and then you add more people, it just adds to the problem, right?
You just brought up something really interesting too, and I actually had this experience late last year. We invested in a company that was touting like a very, very aggressive growth plan in the model when we were investing. And like the first thing we did post investment was go to the CEO and say, "Hey, can you rein that in?" And he was like very shocked and was like, "What do you mean? Like, we were promising 5x growth next year." And we were like, "Yeah, but like the burn ratio to get it isn't worth it. And we would rather that you grow, 3.5x with healthy unit economics and build a sustainable business that doesn't need to fundraise again in 18 months than really trying to shoot the moon on top line growth and not thinking about these things." And so I do think particularly as VCs, like we have the ability to give that breathing room to a founder and to encourage them to be thinking about more. I mean, we should be encouraging them to think about more than top line growth and like longer term strategies to maintain a sustainable business that doesn't rely on constant fundraising.
Yeah, absolutely, totally agree. And now that we are like have started talking more on the investor side of things, so let's kind of try to switch tracks. So when you're evaluating a startup that's a potential deal that's come to you, how do you evaluate them, and what all basis do you look at, and how important is go to market in that aspect? Or do you think that okay, this is something that I can figure out for you? You need to have the rest figured out.
Yeah, it's a really good question. Look, we're doing seed and Series A investing in B2B software. So just to ground us at like the level we're looking at, starts, I think, with market and product. Like, do we feel like we're excited about the market they are in? How competitive is it? What is the opportunity? How defensible long term is, like, I guess there's differentiated and then there's defensible. How defensible is the product long term, and the moat that they're building is something we think about a lot. And then people, I think, is probably like one of the most critical things. Do we feel like this founder has strong founder market fit? Is there an opportunity for them to build a really big business here? How are the team that they've surrounded themselves with? We look at all the standard metrics. I don't mean to minimize that. We are VCs. We are going to dig into the data. But look, we're looking at very different stage companies. We can look at companies that have 7 customers, and the things we're looking at are very different than if we're looking at a product led business that has an incredible number of users and traction, even if they're not monetizing. So, just, there's different pieces there depending on the business model, and we need to be aware of that. And we do a go-to-market audit as part of our process. So we dig in and we want to get to know and meet the team. We want to understand the strategy that's in place. But mostly we want to make sure that we're aligned in how we think about go-to-market, and particularly some of the things you and I have just talked about, which is like relying on data to make decisions, like not hiring aggressively just because we can, making sure that it actually matches a plan, and focusing on building a bottoms up model to match the top down. Um, so that's a huge part of what we're doing. Yeah, we're digging into pipeline, we're understanding the funnel, but I don't think it's that we think, hey, we can help you with this so much as like, do we agree fundamentally in how to build these things? Because that'll help us.
Yeah, absolutely. Totally agree. And let's talk about your biggest learning investing in startups over the years.
I mean, I think I come back to the people piece. There's so many important things related to people. I think it starts with like the grit and determination and motivation of the founder, their ability to execute, and like the kind of bar they hold that trickles down. So when I think about the next like impact of that founder, it's like the founder dynamics. Um, who are the co-founders around the table? Who have they decided to partner with? Um, what is the relationship between them? How do they make decisions? We often have conversations of like, what would happen if you needed to let go of a founder, if at some point you should no longer be the CEO of the company, and seeing how people think about these sort of like fringe scenarios that we hope we don't run into, but like, are they objective and thoughtful about how to even anticipate that? And then I start thinking about the team, and I just think the bar for hiring is one of the most important things that like a founder can hold. And if you early on take shortcuts or compromise on the quality of people that are coming onto your team, I think it's really hard to course correct later. So we spend a lot of time on the people side. And then the last thing related to people that comes to mind is just, I'm not sure I want to use the word culture so much as like transparency. How do you deal with hard conversations? Do you tackle them head on? Do people know where they stand with you? Those types of founders, I think, are just more likely to be able to build a sustainable long term business that has a great team around them. I think it's very hard when you hold everything close to the chest, where people are wondering like where they fit in the org and what the strategy is long term. And I can give some examples of that. We were talking to a founder this week who said I had to have a really hard conversation with my head of marketing who wants to be a VP. And I had to give the feedback of like, you haven't reached the VP level, and here are the 5 things you would need to do to get there. Wouldn't you rather know that as an employee than thinking like, hey, you're on track to do it and you're not getting any feedback? So like that kind of transparency, I think, are the things I'm really looking for. Yeah, so like that's like I would say that people side of just spending time figuring out who are the types of people that you want to be backing is probably like my biggest learning. And mostly I think the learning in that is like how to diligence that, because we don't get years of data on this. We have a set of meetings, ideally over, months, but often over weeks. And it's a really hard thing to get into.
Yeah, absolutely. Totally agree. And I love that all of our conversation has been focused on like how do you help your startup succeed, which is
Yeah.
not very often the case because we mostly talk about investing strategies and the learning part. The question that I ask the answer to that is mostly on the investing terms, that I
Hmm.
should not invest in these startup companies or something like that. But I love that this one also, in your case, is about startups, the people aspect, and how that needs to be taken care of, right? That's great.
Yeah,
And
I mean, it's
yeah,
really funny, Sean. I'll tell you, I do realize, it's an intuition thing and it's not how we should make investment decisions. But one of the things I do think is a real signal now is like when my phone rings, how do I react when I see a name? And when I'm chasing a deal and I like see that founder text or call, am I like excited? Do I want to talk to them? Am I like looking forward to the conversation or am I like, ooh? And if you're ever feeling that way, like, what is that going to mean when you're 5 years into this investment relationship and you're in a hard period, right? So I do think about that. I don't think it's the barometer for investing by any means, but a little bit of a trust your gut moment.
yeah, totally agree to that. And one thing that you mentioned about you try to sense for co-founder compatibility and
Yeah,
what's the relationship. I think it's a really hard thing to judge, as an investor.
yeah,
So how do you try to are there any specific questions you ask? Because like answers can always be made up. So how do you
sure.
like try to judge that relationship? Yeah.
Yeah, look, I think the ideal state for us is we get to know a team long before we invest. So if we have been meeting with them regularly over the course of a year, we have a lot more data points than like if we meet someone and they're like, we're trying to get term sheets in the next 2 weeks. So let's just like caveat all of this with like the best way to do this is a long-term relationship where you get to know each other and you have some guidance on like working together. Regardless of the timeline, we want to see them together on a call. We want to talk to each of them separately, and we're going to ask questions about how decisions get made and get some specific examples to understand how they divide and conquer on things and where they work together on things. I think it's really interesting to hear how they talk about like how they make space for themselves and strategy versus when they're working like top down with their teams. There can be different interactions. Um, and then we do references. And so references for us, there are, the ones they give you. There are people they've worked with in the past, but I would say like my favorite references to do are former employees. So who has worked for them in the past? Why did they join? Why did they leave? What are their observations? And those former employees, I think, can really help you understand like the pull back the screen view of the culture and what's really happening internally.
Yeah, I totally agree with that. And let's move on to my last main question before we
Sure.
move on to the rapid fire round to close it out. And this one is about what's one thing that you'd like to change about the startup or VC ecosystem?
Only one? Um, I might
I'll
have to
give you
get I
two.
might have to
Okay.
give you 2. I was
Yeah,
gonna say,
sure.
yeah, I think, look, the first one and something we think about all the time is more money flowing to more diverse founding teams. I think there's a lot of talk about it. There's a lot of progress being made, but not fast enough, and it's something I'm certainly passionate about. And finding ways to impact that ourselves as well as like be part of a broader community driving that is super important. The second thing that I just, I think we're on the journey of right now is bringing this like valuation expectation down a bit. And I think, if we think about 21, 22, and now we're clearly on that journey. But one of the things I'm constantly thinking about is like, I really want to back founders who are trying to build something big, but like want to control their own destiny. And what I mean by that is like, how do you get people off the hamster wheel of raising? And it's a very odd thing to say, I think, as a VC, but I'm looking at this as like, I want them to be able to raise a B round or a C round if there is something to invest behind and they are super excited to do it and they want to invest in this new growth endeavor or they want to make an acquisition or whatever the thing is. But I don't want them to have to. And I am finding that that's a conversation I need to have earlier in the deal process of like, what are your goals here? Because it's really different to say, I want to raise, 2 million and then 5 million and then a $20 million round and a $70 million round. But I want to hear somebody be like, yeah, like my goal is to bring in this funding round so that I can get X number of customers so that I can, build a cash flow positive business and then decide where I want to invest next. Like we don't need to have the next 7 years mapped out. We need to have optionality and like a really strong foundational business that we can build on. And I think that is permeating more of the companies I'm talking to, but I wish that would happen more and faster.
Yeah, I absolutely love that take. But what I think is the view in the VC ecosystem is that they are kind of thriving on markups
Yeah.
and the exits that they get. So they kind of want that thing. They're like, okay, go and raise the next round, so that we can pass that bait and on to the next one
Yep.
and stuff like that. Yeah. But how's that different in your case? So how do you get results as a VC firm? Because ultimately you either need to show exits that okay these startups in our portfolio exited for multiple x's
Yeah.
and that's how you get a return.
It's the
So
same
let's say,
way.
yeah. So like, what's that in your case? How are you planning that exit strategy in your? Is it like, okay, they get profitable and then they go for an exit straight away and not think about raising a next round instead? Yeah,
No,
or
and
something
most
else?
of our companies are raising additional capital. Like, I don't mean to say that as like that's for everyone. My call out is
Okay.
more a mentality of the founders. So I think there's a big difference between continuing to build against a vision and just like constantly being in like, I have to raise for the next 24 months, from being like, I want to be in control of my own destiny where I want to have the options to make those decisions. And if you're raising at slightly lower valuations, you're creating optionality where, yeah, you could go the IPO path, you could go get acquired. But if you raise at a $1 billion valuation, you're closing a lot of doors early, and that acquisition probably isn't on the table, or you're going to have this pressure from investors to deliver a giant outcome. We are we're investing out of a $150 million fund, just for context. There are great ways for us to drive returns that are not every company reaching this like astronomical outcome. And so I think of it more as just like create optionality for the founders, make decisions along the way. But obviously, our fund structure relies on there being big winners, but those big winners can look different. And I think when we raise at too crazy valuations early on, we close the doors to those options over time.
Absolutely, yeah, and that's something we've talked about on the podcast before as well. That like reasonable valuations are good for everyone, right?
Yeah.
The founders, the VCs, and everyone in the community. So it helps. All right, now let's do the rapid fire round. And here I'll ask you 5 quick questions
All right.
about the fund, and you have to give 5 quick answers. Sounds good? All right. So the first one goes: what are the sectors and regions you invest in?
We are completely agnostic generalists. We will invest globally. I would say the bulk of our investments are in North America, but like we have investments around the world. And we are sector agnostic. There are themes that each of our partners lean into, but we will look at anything. We are generalists within B2B software.
Great. And what's the typical stage you invest in?
Seed and Series A, we're generally looking for companies that are showing strong signs of early product market fit, which for us means customers that have generally gone through a renewal cycle or are expanding, using the product in similar ways, showing like strong activation and adoption.
Right. And what's the typical check size?
2 to 6 million. We have, some flexibility, no hard and fast rules, but generally, 2 to 6 million and looking to buy 15% plus of a business.
Right. Where can founders apply for funding in case there is a direct way?
I guess you could go to our website, but all of our emails are out in the world, and feel free to email any partner. That's the real answer.
That's great. Last one: where can our listeners follow you?
Substack. So I run a weekly newsletter called Dear Stage 2, where I answer questions from the sales, go-to-market, and founder community every week. It's very like Dear Abby style. So I take one question I've gotten during the week and share a response with the world. And part of that is really pulling in our incredible LP base and our network to make sure that you are getting like current advice from current operators. Follow me there.
Absolutely. I'll make sure to put that link in the show notes below. Thanks so much for
That'd be
coming
awesome.
on, Liz. And it was a pleasure hosting you, and happy investing.
Yes, thank you. Great to see you.